Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, talking to you from New York City on this, the 9th day of June, 2020. And I do want to remind you that I'm the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. You can subscribe to that by going to miningstocks.com. Miningstocks.com. We like to put in a plug for Chen Lin, chenpix.com. Go to chenpix.com. Chen's expertise, especially in the biotech sector, but also in the energy and the mining sector as well. And then, as always, we like to remind you of Michael Oliver, who will be speaking to us in a few minutes from now. It's olivermsa.com, olivermsa.com, to keep up with a purely objective technical point of view of the markets. Michael certainly does have his views of markets. He is a free market advocate for sure, but he lets the markets tell him what's going to happen next rather than his own preconceived ideas. And Michael, as I say, will be with us in just a few moments from now. I do want to thank our sponsors. This week's sponsors, RN Resources, Great Bear Resources, Benchmark Metals. They're a new sponsor. We want to welcome them today. Hannon Metals, Irving Resources, Novo Resources, and Sitka Gold Corp. And I will be speaking to Jim Gregg in the second segment of today's show. He is the president and CEO of Benchmark Metals, a very fine company that is developing a multi-million ounce gold and silver deposit in north central British Columbia. It's one that I'm really excited about, own the stock myself, and have had it in my newsletter now for a number of months. I've titled today's show The Path to Monetary Collapse. And insane stock valuations, how long can that last? The path to monetary collapse is something we talked about last week. We're likely to get onto that topic again today with John Rubino in the second half of today's show. Jim Craig, as I mentioned, will be with me in the second segment, and Michael Oliver will be with me momentarily after I talk a little bit more about today's show. Well, when it rains, it pours. Even before COVID-19 tremors in the repo markets were suggesting growing instability in the financial markets. That went back to September of last year. Then COVID-19 hit us, raising prospects of a great or even a greater depression, unfortunately. If that were not enough, we suddenly have what I think is an attempted hard coup against the current U.S. government with massive pillaging, death, and mayhem in every U.S. city, major U.S. city around the country virtually. And if that isn't enough, the latest GDP estimates by the Fed is for a negative 52% in the second quarter of this year. Meantime, the stock market continues to climb with little hesitation. Today, it does seem to be not as definitively higher, but it has been incredibly high, detached seemingly totally from underlying reality, allowing the filthy rich to get even more filthy rich. That seems to be the direction of things. Since this show started back in March of 2009, we have explained that Keynesian monetary theory, and actually it's more than a theory, unfortunately, it's the practice of our monetary gods, and that it was really leading the way towards poverty by rewarding consumption and punishing savings. Now, those closest to the printing presses, meaning large corporate interests, banking interests, the military-industrial complex, and all those people that work for those organizations, as well as federal government employees, they're doing quite well, doing very well, in fact. While the main stable force of society, the middle class, the producers, the people, the miners, the manufacturers, the farmers, the inventors, they are being killed by this parasitic system. Some of you might remember when Democrats once stood up for the manufacturing and middle class, and when they also really roiled against the military-industrial complex. If you wondered why you don't hear from them complaining about those same social issues now, well, I would suggest it might just be because the Democrats themselves, the elites within the party, are now a part of that parasitic corporate and military-industrial complex, the banking structure, and so forth. They are reaping tremendous profits. It's no longer, it used to be known as the Republican Party being the rich man's party. Well, I dare say that probably there's more wealth in the Democratic Party these days than in the GOP. And this is, I think, very much of what Trump was standing against. And Trump, I believe, really meant business. Now, you can argue with the guy and the tactics he's taken, all that, but he really got the vote of the people that felt disenfranchised, the middle class, in Middle America primarily, flyover people. But if it's true that I'm right, that the elites in the Democratic Party are who I think they are, there should be no surprise then that the Fed is continuing the same practice that they underwent in 2008, 2009 when they bailed out the financial system and pumping huge amounts of money into the system, allowing the stock market to rise. At the same time, people are literally, more and more of them literally going hungry. The middle class now becoming a poverty-stricken masses in America. So in light of this economic depression, we just really want to ask, how long can this sort of thing go on? How long can the equity markets continue to rise? That's a topic we want to talk to John Rubino about in the second half of today's show. And as I mentioned, we'll be talking to Jim Gregg in the second segment, just in a few minutes from now. Benchmark Metals is really a very exciting story that I'm really looking forward to hearing what Jim has to say. But before we go to Jim and their first commercial break, Michael Oliver is here with us, as he is every other week. Thanks for joining us again, Michael.
Hi, Jay. Good to be back.
Always good to have you here. As often as we can get you, you're welcome to come on the show. Now, I want to ask you some time ago were turning quite bullish on commodities. Commodities really, well, I don't know, they haven't done all that well. Gold led the way, as you pointed out. But what are you seeing now for the commodity sector? What is your vision currently? Because we haven't asked you about that in the last few weeks.
Yeah, well, I think, you could fundamentally understand this point that when the Fed prints money, it goes somewhere. Okay. Mm-hmm. Now, in 2009, it went into the stock market. Well, that made some technical sense. At that point, MSA was rampantly bullish on the stock market, March of 2009. In fact, we pegged the low within a week. And it was technical. But at that point, the stock market had gone, the S&P had gone from a high at 1570 down to 667. I mean, it's not going to zero, okay? That was a pretty good drop. And therefore, it made sense that when they pumped the money, some investors, smart money, would put it into that market because it was washed out. A lot of the risk was removed, so forth. Now, here we have the opposite situation. We have a 11 to 12-year-old bull market that's thrashing around. In fact, if you look at an S&P, like a monthly chart, go back to 2018, January 2018, you can draw a line sideways, and we've been above and below, above and below, above and below, with no real net gain. I mean, you wait 2 months, you're negative. You wait 2 months, you're positive. Just a widening, sloppy pattern of action, in other words, like somebody's having a heart attack. Yeah. So from the investor point of view, or for the pension fund point of view, who desperately need return, which has been denied to them, because the central banks have taken rates to zero or effectively, as close as you can get, they need the return from the stock market. Well, so the Fed has come in and hopefully, they're bidding up the corporate debt market overtly, buying ETFs and junk bonds. And they're no doubt hoping the stock market, or trying to, as aggressively as they can. And the question is, a lot of investors, no doubt, the recent buyers have thought, Fed's behind us, we're going up again. Thinking along the lines of 2009. Well, put it in context, guys. Look at the charts in 2009 and look at the charts now and tell me, okay, this is not overdone, and et cetera. So our argument is that money, that capital, that liquidity is going somewhere, but we think investors, and we see evidence of it, will plow it into assets that have less risk. That would be the commodity category. Why? Because it's been bombed out. In fact, it was bombed out in 2016. Look at the Bloomberg Commodity Index. It went sideways for 3 or 4 years, and recently it went down and spiked briefly below the 2016 low, is now headed back up to try to get back above it, and I think it's going to V-bottom. Some markets didn't take out, like copper, for example, dropped hard, tested this 2016 low, did not take it out. Oil took it out. Grains did not. They basically floundered sideways for 4 years now. So they're bombed out in the commodity sector with no other place to go but up. And with this money flow is likely to move into that area and into stocks within the stock market that are related to commodities. I suggest oil stocks and so forth, and base metal mining stocks. It'll put further wind at the back of gold once the commodity upturn becomes evident to most people. We've got some numbers that tell us when and where it's become a solid conviction on our part that it's turning up.
Mm-hmm.
That won't excite the price guys, but there's some levels above that will excite the price chart guys that will tell them, oh my, the commodity complex is turning up, meaning wind at the back of gold.
Mm-hmm.
Also, while the stock market's beating its chest, watch the dollar.
Mm-hmm.
The dollar has been caving recently, but in a quiet way, but still caving. It's now down within less than 1 point, dollar index I'm speaking of blasting out an annual momentum floor. That we think once it breaks it, it's headed down more sharply and noisily. Euro is doing precisely the opposite. The Canadian dollar and the Australian dollar are starting to soar about a V-bottom type lows. Of course, they're commodity-related countries in terms of this, output. So all these little pieces sort of fit together and point in one direction, and that is, yep, central banks are printing the money, but it isn't going to go where they think it's going to go.
Mm-hmm. Well, that's very interesting because just this morning, Stephen Roach, a famous economist, of course, at Morgan Stanley for many years now, now a professor at Yale, talked on Bloomberg about a crash in the dollar that is coming, and he gave his reasons. Certainly, if people look around and start to realize that the dollar is becoming ever more worthless, they might start to want to buy tangible assets, and of course, the most likely ones are those precious metals and commodities, I would suggest. Now, speaking of precious metals, talk to us about gold. What is your picture there? It's not been going anywhere lately.
That's right. There's two assets that generally were accepted as alternative, quote, to the stock market. That's T-bonds, U.S. government bonds, or foreign government bonds as well, and gold. And so when the stock market caved, those are the asset categories that money flowed into. Now, when the S&P made its low in March and then started its couple of month rally now, you would have thought that gold and T-bonds would collapse. And instead, what gold did is it turned around and made a new high for this move, and T-bonds went back up toward their high and went sideways. So while the S&P has gone up for the past couple of months, if you look at a weekly close only of gold, or a monthly close only, or T-bonds, futures, it's a sideways yawn. Now, T-bonds last week did drop sharply, but they're jerking back up very rapidly, and we think they're ready to resume their upside. Last week was a fake out. Gold tried to break down yet again, there's umpteen times in the last couple months, and just can't seem to get it going. So look at a gold chart and put yourself in a bear's position and say, how are you doing, bear? You've been selling me for 2-3 months now. Are you making money? And the answer is no. No.
So at some point that bear is going to get discouraged and throw in the towel, I suppose.
I think he's going to be destroyed, and probably rapidly.
Rather than discouraged, yeah. Well, if he's leveraged short, let's wish him well. No, let's not. All right. Well, so rates, you think, Michael? Because this is the big thing in my way of thinking. When confidence is lost, money will no longer flow into U.S. Treasuries, but for the foreseeable future, that's going to continue, you believe, right? I mean, whenever the stock market gets whacked, money's going to instinctively go into the Treasuries.
I think there's like one more time where the T-bonds will behave inversely to the stock market. In other words, if the S&P rolls over now and the NASDAQ, which made an all-time new high marginally, if it doesn't sustain and suddenly you roll back down into that ink I described to you a minute ago, sideways ink, then the money's going to flow back into T-bonds again as an alternative in a, quote, safe haven. Now, at that point, sometime next quarter or the fourth quarter of this year, I see T-bonds as being potentially vulnerable to going down, meaning yields go up. So at some point in this overall process, we expect the government bond market to join hand in hand with the equity market to the downside, the price now. And which means that low rates on the short-term end by the central banks won't save the longer rates like the 10-year and the 30 years. And therefore, those safe havens in T-bonds will prove not to be. Well, then what are you left with?
And Stephen Roach in his article is wondering how high interest rates are going to have to go when the rest of the world abandons the dollar and no longer sends the money to us to allow us to live beyond our means. How high are interest rates going to have to go to allow the U.S. Treasury to fund itself? I mean, that's a question for another day. But Michael, we're out of time. Thank you so much for being with us and sharing your thoughts. Always so valuable. I know our people love you. You're one of the most popular guests we have, so thanks again for being with us.
Thank you, Jay.